When should you invest in industrial stocks, and how do you find the very best in the sector? In this video, I'll not only show you the real data on how industrial sector stocks do in bull and bear markets, I'll show you how to think of this group as a whole and how it fits with your investment strategy. Then I'm going to show you how to find the best stocks to buy and reveal 5 industrial sector stocks to watch in 2020. We're talking the industrial stock sector today on Let's Talk Money. Beat debt, make money, make your money work, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. The industrial sector is really weird, and I'm glad we're including it in our stock sector series. There are some extremely popular companies here, but I feel like investors don't think of it like a sector as they would maybe tech or energy stocks. Like hear all the time that investors are really excited about the tech sector stocks or want those big dividends and utility stocks. Now, individual companies in the industrials are hugely popular. You know, companies like 3M and Boeing are some of the most active stocks on the market. But you're never going to hear an investor say, I think I need more industrial stocks in my portfolio. They just don't think of it as a sector as a whole, how it fits with their investing strategy. I think that's a missed opportunity. So in this video, I want to open you up to the idea of thinking about the stock sector as a whole. We'll talk about how it performs versus the stock market in both bull and bear markets. I'll show you when to start increasing your exposure to this sector and reveal the 5 best industrial stocks to watch going into that 2020. It's part of our 11 video series uncovering the best companies in each stock sector. Over these 11 episodes, one for each sector in the economy, I'll show you how to pick the very best in each. We'll look at some of the biggest trends and how to pick stocks to buy. Then I'll reveal my 5 favorite stocks in each sector. And if you're coming in later to the series, I'll link in the first comment below to the most recent video. I'll also be linking in the video description all the videos in the series so you can see all of the stocks in each sector of the economy. So when we talk about the industrial sector, we're actually talking about a huge part of the economy and many more industries than is in our sectors chart here. This sector includes pretty much every industry in manufacturing, aerospace and defense, construction, and transportation. Now, the sector underperformed the stock market only slightly over the past 5 years by about 6%, but has almost exactly matched the market returns in the past year. And because the sector includes so many industries, so many groups of companies that fulfill a basic component of the economy, the sector tends to follow the economy almost exactly. It's why industrials are called a cyclical sector, because it tends to rise and fall along with that economic cycle. Now, we're going to use this to our advantage though, building this into our investment strategy, which I'll explain in a bit. First though, I use the industrial sector ETF to compare returns for the sector on a bull and bear market basis back to 1998. Here we see the return on stocks in the industrial sector against the return on the broader market, the S&P 500, in 5 periods. And you can see that the industrials tend to outperform the stock market during those bull market periods. So when the economy is growing and stocks are doing really well. Now, the evidence on bear markets is a little less clear. The industrial sectors did better during that 2000 to 2002 bear market, beating the market by almost 7% over that 2 years. It underperformed, though, in the next bear market from mid-2007 to March 2009. The industrials lost almost 6% more than the broader market. So we can say that the industrial sectors is probably going to do really well, produce those stronger returns during a bull market. In a bear market, it might or might not lose more than the rest of the market, but we can be more certain that it's still going to track the market pretty closely. Now hang on to that thought, because I want to look at one more chart here. Research by FactSet that we've been using throughout the series. Now this shows the price to earnings ratio by sector, so that measure of how expensive a sector is versus these other groups. The dark blue bar here is the current PE ratio on a forward basis, while the green bar is a longer term 10-year average ratio. Now this not only tells us if a sector is more expensive than another sector, but if a sector is also more expensive than its own average over time. And here we see the industrial sector, third from the left, with a current PE of about 16.2 times earnings, which is slightly less expensive than the market average at 17 times earnings. Again, this gets us back to that idea that the industrials are going to follow the broader S&P 500 very closely. So the stocks in the sector are about 5% cheaper than the rest of the market, and we can compare that current PE to the 10-year average of 15.2 times earnings. So while the sector is cheaper than the market, it looks like it's about 6.5% more expensive than what it's been on average over that longer run. Now, while the sector might be a little bit more expensive than its long-term average, that 6% premium, it's still nowhere near as expensive as we see in some of these other sectors like tech or utility, which are both more than 30% over their long-run PE ratios. So as we head into 2020, a lot of this is going to depend on your market outlook, but I feel like the industrials are in a good spot right now. You definitely want to think about increasing your exposure to the sector as a whole if you think the economy is going to keep growing. We saw how the sector wins out in that bull market environment. And now, even if you think that the economy might struggle a little bit, you don't want to neglect this sector altogether though. It's a toss-up whether it's going to underperform, and it's not an expensive sector anyway. Now I want to cover 2 sector ETFs before revealing those 5 stocks that I'm watching in the industrials. You can think of these industrial funds for that broader exposure when the stock market looks to keep rising, giving you an investment in the sector as a whole that's likely going to beat the market. First is the Industrial Select Sector SPDR ETF, ticker XLI, and its 2% dividend yield. The fund holds 69 of the largest industrial companies and across every industry. And we're talking companies with an average market cap of $74 billion here. The expense ratio is fairly low at 0.13% annually, and if nothing else, just looking at this fund holding gives you a good idea of the diversity and exposure of industries in this sector. For our next fund, I wanted to highlight the aerospace and defense industry with the SPDR S&P fund, ticker XAR. Now this one is a little more expensive at 0.35% expense ratio, but I love this theme right now. We are in a historically partisan time. The Republicans and Democrats in Washington just seem like they want to fight about anything and everything. There is only one industry that's getting pretty much bipartisan support, and that is aerospace and defense. An increase to the budget for defense is pretty much the only thing that passes without argument, and now with what's looking like the beginning of a space race part 2, this industry could be in for big sales growth over the next decade or longer. The fund holds shares in 30 companies and has produced a 21% annualized return since it started trading in 2011. Now I want to focus on individual stocks in the sector because this is where I think you get those outsized returns, finding the leaders with a competitive advantage in each industry. Now, as I've done in those other videos of the series, I've tried to pick stocks across as many of the industries in each sector as possible to give you a broader mix. I used the same fundamentals that we described in that first video of the series. I screened for stable or rising sales and an operating margin that's competitive against those other companies in the industry. I looked for a debt-to-equity ratio and other debt measures that were lower than competitors as well. Now, I detailed these factors and how to use them to find stocks in our first video, so I don't want to repeat too much here. If you haven't seen that first video in the series, I'll link to it in the description below the video. Make sure you check that out because these are the fundamental measures that you can use to find the best companies in any sector at any time. Looking for our 5 best industrial stocks, so I also looked for a catalyst for growth. Companies with not only a competitive advantage over their peers, but a reason to send that stock price higher. For some, this might have been those low energy prices, higher government spending, or just the potential for that surprise in some part of the business. Our first industrials pick here is going to be $78 billion Caterpillar, ticker CAT, and a solid 2.9% dividend yield. Caterpillar is the largest heavy equipment maker in the world, with 16% of the global market share alone. Now, like most though in this heavy equipment space, weak buying in energy, agriculture, and mining have all weighed on the shares over the last few years. Now, instead of buying to replace the equipment that they sold in the third quarter, dealers sold down their inventory on worries about that trade war, which led to a miss on sales and earnings for the quarter. Despite all these problems, CAT has managed it well and kept overall sales rising on a year-to-year basis. There's reason to believe that a turnaround is coming in the near term as well as the longer run. And dealers are going to need to restock their inventory this quarter or next, which should help boost those sales beyond expectations. Also, the service revenue, offering maintenance on equipment is becoming a larger share of those total revenues. This revenue is recurring and actually a little counter-cyclical if you think about it. So if the economy slips, then heavy equipment users are going to be keeping those older models and instead of buying new ones. So they're going to be getting more service to keep those running, which should help offset that purchase revenue on the economy. Shares trade for just under 13 times earnings, which are expected lower by 4% over the next 4 quarters. The recent string of earnings misses makes this one a little bit more volatile, especially around those quarterly reports. If they can beat expectations on that inventory restocking next quarter, it could lead to a bump in the share price. CAT has $7.9 billion in cash on the balance sheet and just $25 billion in debt. It has a debt-to-equity ratio of just 1.7 times, which is well under the 2.5 times debt ratio at competitor Deere. Now, analysts covering Caterpillar have a wide range in targets from a low of $110 per share to a high of $165 each. Next here is one that I think investors can get excited about, United Technologies, ticker UTX. Now, UTX is a really interesting play because essentially you're getting 3 companies over the next year. The company is spinning off its Otis elevator and carrier HVAC business before a merger with the aerospace giant Raytheon. Now, the spinoffs are scheduled to happen early in 2020 with the merger to follow during the year. Now, Otis is the name in elevators with over 2 million elevators installed globally and no real competition here. The division makes a lot of money on servicing, and the transition to greater connectivity through the Internet of Things, that IoT, could really drive profitability on this one. For its part, Carrier isn't the biggest HVAC company, but it's a strong brand, and I think both of these companies can do better when management can just focus on their single business instead of being wrapped up into that conglomerate, that 127 billion industrials conglomerate. As for UTX, after the split, it's merging with Defense Electronics Raytheon to create a more pure play in that aerospace and defense idea. Shares trade for 17.7 times earnings, which are expected flat over the next year. Of course, when you have these 3 companies split and then you've got that merger, earnings are going to be hard to estimate for a little while. This one has had a strong run over the last 2 years and is a little bit more expensive versus the sector, but I like the spin-off idea and I think it could produce 3 stronger companies. Analysts have a low target at $150 a share and a high at $170 per share over the next year, but this is one where you'll have to hold for a few years to really see where these 3 companies are going. As much as I like that UTX play, our next pick, Northrop Grumman, ticker NOC, could just be the stock of the future. The $59 billion aerospace and defense company is going to be smaller than that UTX Raytheon combination, but it's in all the right businesses right now. Not only does Northrop gobble up a good chunk of our ever higher defense spending with its mission systems and cybersecurity services, it's also deep into those space systems that could get a big boost over the next decade. The company won an F-35 contract this year that took its order backlog to $65 billion. That's 2 years worth of revenue booked on backlog. Shares trade for 17.2 times earnings, so a little bit more expensive than some of the stocks that we'll look at in the sector, but well worth it for a strong company. Earnings are expected 6.5% higher over the next year, but will likely be much higher given management's history of beating expectations. Analysts have a price target of $350 at the low end to $437 per share at the high end. With everything that Northrop is in, from defense and cybersecurity to space systems, I think this one could run well into the next decade, or, well, until at least the products become self-aware and come for us all. Next in our industrial stock picks is $2 billion Terex, ticker TEX, a leader in heavy equipment manufacturing, including cranes, material processing, and platforms for pretty much every sector in the economy. The environment for heavy equipment manufacturers has been tough, but Terex has managed to eke out sales gains and greater profitability. Management has improved the operating margin from 4.7% in 2016 to over 9% this year, and the company has a $746 million backlog of projects that should support those sales in the future. Now, shares trade for just 8 times earnings, though profits are expected to nosedive 35% over the next year on some divestitures and weakness in the platform division. This is already baked into the shares though, and even on that lower earnings, shares are still only at 12 times earnings. This one is going to be closely affected by non-residential construction, which could mean a rebound if we get any kind of an increased infrastructure spending out of Washington. It's the only kind of fiscal stimulus with any kind of support from both sides, so there is a chance that we see something in the next few years. Analysts covering Terex have one of the widest spreads on price targets that we'll see in this group, with a low target of $20 per share and a high at $44 each. The company has a strong balance sheet and some attractive assets that could actually make it an acquisition target someday. 3M, or ticker MMM, is the most diversified in our list and offers a 3.4% dividend yield. 3M makes products for just about every industry imaginable, and it's one of the few on our list with sales into that consumer market. Those consumer sales have helped a lot in that weakness for some of the commercial markets like auto and semiconductors. Now, the company is also the most geographically diverse in the list, with 60% of total sales coming from outside the United States. Now, a combination of that weak auto market, China sales, and the scare over PFAS litigation risk have hit the shares for the better part of 2 years. Shares trade for 18 times earnings, which are expected flat over the next year. Despite the negative sentiment, though, this is a company that is constantly innovating and is a best of breed in so many products. 3M's advantage has always been its research and development division, with more than 120,000 patents granted over the last 117 years. Since it doesn't license most of its products, it's able to keep a better lid on those patent secrets and charge a premium on its products. Analysts are split on the shares with a low target of $143 each and a high at $200 per share. Watch the most controversial video in the series and our 5 oil stocks I think could be worth double their current price by clicking on this video to the right. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.